Welcome. I'm Jonita Stanton. We have Reginald Perriman, Shaka Williams, and we are Tasari. This is a There's Something About Real Estate podcast where we talk all things real estate.
I had a new swag. Shaka got on a new swag with the like, follow, and subscribe.
No, I went in. That's all I wear every day now.
Oh, for real?
Yeah, I don't even wear no clothes no more.
Okay.
He never wore clothes. He went from Masari gear to Tasari gear.
Yeah.
And sometimes some Legacy Park gear.
All right. That's dope.
But they make it easier as hell now. And they only $12 a shirt. I mean, well, that's $24 a shirt now. I mean,
What?
$12
14?
$12 to print it and $12 to buy it.
That's for skinny people, though.
No, it's for everybody.
I'll be ordering stuff, and it'd be like, don't
Well, you
be
got the
fitting
embroidered shirt with the Nike
Yeah,
and the
that cost
collar
way
and
more.
stuff. That's a good shirt.
Yeah, this my
He
golf
got the
shirt.
KW Metro. You the managing broker over there right now, right?
Yeah, one of them.
Managing. Oh, wait. How many y'all got?
It's two. I'm the city office managing broker, but I step in for Tony at the Royal Oak office.
Oh, you took over the managing broker position. Wait a minute.
City.
Okay, I'm confused.
So I needed to be calling you instead of Tony, though.
No, I called Tony.
All right, I brought that up for a reason because we getting ready to. Oh, well, that's the next episode.
Yep.
But still, so I'll bring it up on the next episode. But we're talking assumable mortgages or one of the strategies that could potentially help people pay less monthly.
Yeah.
If they were able to find some by way of assumable mortgages.
In this time of the real estate.
In this climate.
In this climate. Yeah.
So
cycle.
We talking about the pros and cons of an assumable mortgage. And first explaining what it is. So just basically you're assuming someone else's mortgage. So it's either a simple assumption where now the lenders still get involved. They used to you just sign an assignment agreement and you take over the mortgage. But a simple assumption back then, the owner name would be removed from title, but not necessarily removed from the mortgage altogether until it's paid off. So you have to assume that the borrower was going to pay on time because they would come to you as a backup. A formal assumption is when the actual buyer has to actually qualify for that loan with the lender, and then the entire mortgage is transferred over and assigned to the new borrower. So it's
okay. I feel like you went kind of really fast. Like you said, you were going to explain what the assumable mortgage is, but then you went into two different types of. I think we still need some of the definition. Right. So like exactly what is an assumable mortgage?
Okay, so I'll give you an example. Shaka has a home. He paid $300,000 for it. Right.
Let's use a different example. I feel like everybody uses $300,000. Pick another number.
Okay, Shaka owns a home. He pays $600,000. His balance now is $520,000, right? But he has a great interest rate, very attractive interest rate, 3%.
Sub 3.
Right. I'm coming to buy that home, so Shaka pays $600,000 for it. Maybe it's worth $680,000 now. I'm coming to buy that home for $680,000. Shaka owes $520,000. I'm going to pay Shaka the difference in cash, and I'm going to assume that 3% mortgage, right? Makes sense because the payment on that balance at 3% is going to be a lot less than what I would get at 6% or whatever the current rate is now at the new purchase price at $680,000. Now, that may or may not make sense for everybody. It may not be the best situation for everybody, and that's what we want to discuss today. Is an assumable mortgage right for you as a seller or the buyer, and what are the pros and cons of doing it that way?
Okay.
Yep.
So you went into the types of assumable mortgage, and you're saying there are two types, formal and standard.
Right.
Or
simple. I've always called them simple
and formal.
Right, and formal.
Simple and formal.
Right.
And Then you mentioned like back in the day. When you say back in the day, like how many years ago back in the day?
I mean, I
At
started in the
least.
90s, so it hasn't changed. Assumable mortgages have always been around. It's just it didn't make sense to do them in most cases, or the market just didn't demand it. And then in a lot of cases, during a lot of years, people didn't have enough equity for it to make sense. Or on the flip side, they had too much equity for it to make sense. So to give you an example, let's say you got someone that bought their house 4 years ago, and we were in a market where values didn't appreciate as much as they did recently. So they paid $250 for the house. 4 years later, it's worth, I don't know, $270, right? And their balance is $240, right? So you got $30,000 there. That's not a lot of money because the new buyer, if they were buying with their own mortgage, they're going to spend their down payment and closing costs is going to be roughly about 10%. They're going to spend $27,000 anyway. So they can just assume the current mortgage if it's a better interest rate. That would make sense, right? Well, in some cases, it would make sense.
Because you're not bringing so much cash to the table.
Right.
You're bringing about what you, maybe a little more than what you would have been bringing in anyway.
Anyway, right. Now, if you got somebody and their balance is $200,000 and you're buying a house for $600,000, we can't really justify you giving them $400,000 regardless of what the interest rate is, right? It just probably wouldn't make sense.
I agree.
Unless you were already intending on putting $400,000 down, but with your new mortgage, your rate was going to be 6 or 7%, and their mortgage interest rate is 3%. Then that would make sense.
So I want to just go back a little bit, and I got an example for that rate too. But you said something about back in the day, we used to kind of do an assignment and you assign. The danger in that is the due on sales clause. If we continue to do that,
well, not if you actually do an assumption, because you got to keep in mind you couldn't do either the simple or formal assumption without the lender's approval. To do so. So the actual mortgage would be assigned to the new borrower.
You're saying one of them it takes all, you have to qualify the traditional way.
The formal assumption.
You have to go through the full process of being approved formally.
Both of them are still through the lender is still approving both.
Right.
So there's no doing sale.
Right.
Well, so it's two different approvals. So one is the lender saying the buyer will become the new borrower. We would put this person on the mortgage, but it wouldn't relieve the current borrower, the owner, from responsibility in case this buyer doesn't pay.
So they're like a guarantor in that.
Yeah, and the simple, what we call a simple assumption, is the borrower didn't necessarily have to qualify for the mortgage. So let's say the mortgage balance is $220, they didn't have to qualify for the $220 income to debt ratio and all of that. They were just simply given an assignment form. The lender would record it, and then you would transfer ownership as far as the deed is concerned. But the downside is you're transferring ownership of the property, you're adding someone to the mortgage, but most lenders will still hold you liable for that mortgage. A formal assumption is where you transfer ownership, but you're actually removed from the mortgage as the seller because the buyer has to actually qualify for that mortgage.
Okay.
So whatever that interest rate, mortgage payment, and balance, they actually have to have the income to debt ratio and credit to qualify. So this would be somebody actually that can actually go out and get a mortgage on their own, but your mortgage rate is more attractive and your mortgage terms are more attractive than what they can get starting fresh.
Because the way you were originally describing it, when you said we used to do it back in the day and people would kind of just sign over, it sounded like you were saying like the assignment to where I walk up to you and say, oh, you don't want the payment anymore? I'll take the payment.
Oh, no. Well, let me say this. People did do that, but
that's not a assumable mortgage.
We're teaching people how to do stuff the right way. But people did do that, and that's when you would see like the due on sale. Yeah, we not talking about that. But yeah, people did
So we're
do
talking
that.
about where you find out that someone wants to make a move,
Right.
and then you guys contact their current lender
Right.
and say, "Hey, do you guys offer the ability for someone to be able to assume my mortgage?"
Right.
And then they'll tell you yes or no, and then you can start that process once you get the yes and the
E
clear from your current
exactly.
lender.
And the lender will send you a package to complete for both parties to complete.
Okay. Now, and you kind of discussed a little bit about like what happens if there's much more equity than the seller would like to walk away from.
No, then the buyer would wanna bring. So what he's
Right.
saying is if you only have a $200,000 mortgage, I mean, he said it
You
it's
said the same thing, but you just chose a different side.
no, well, you said how much the seller
Right.
would have to walk away from. The seller not having to walk away from nothing because the buyer bringing the money. So the issue with there isn't the seller walking away from equity, it's the buyer bringing too much money where it don't make sense for them to bring so much money.
Right.
So in the scenario he gave, so it's some ways around that though. It's some
Yeah.
creative financing ways that you may still do that, but which I guess we'll talk about in a little bit. But um and like in the scenario he gave, if the mortgage is only 200,000 and you buying a $600,000 house, you bringing 400,000 in cash, and you're you got a 3% interest rate on just the 200,000, it's not worth it
Right.
to me.
Yeah. So
Be
we're talking
From the
about
buyer's perspective, not from the seller. The seller's still getting their money. They don't care.
here's to who would benefit from this in this current market, in this 2024, 2025 market. Anybody that you know that's selling that had a 3% interest rate and their equity didn't skyrocket, it didn't appreciate out the roof. So they paid 400,000 for the home. Maybe it's on the market for 450. So there's a $50,000 spread. You as the buyer, you're going to buy that house for 450. You're going to need anywhere from 35 to 45,000 between your down payment and closing costs. I'm just estimating to buy that house anyway. But for 50,000, you can get the same house but at a 3% rate compared to getting your new mortgage with a 6% rate. Now here's the thing. Now, if you buying that new house, if you assume the mortgage, you don't have as many like closing fees and everything. So you're technically giving the seller what they were going to walk away with, but you're assuming their mortgage. And since you qualify for a loan anyway of 450, you're more than likely going to qualify to assume their mortgage. And they've already, you don't have 30 years left. You only have 25 or however long they had the property. So you don't have a full 30-year mortgage to pay off.
right. So what I was leading with, back to what I was saying, the so that the seller would not necessarily, because it's not always like that big of a gap, and it's not always like that small of a gap.
Right.
Somebody could be prepared to put down 20 or 30%. You have a person, let's say they were going to buy a house for $250,000, right?
Yep.
And they were already prepared to put down 20%.
Okay. Yep.
That could very well cover, that buyer in that case has the cash to come to the table with to give the seller the equity that they were looking for
Right.
and then be able to assume that loan. Right.
And then look at what would that payment be on that home at just say 6% interest, for example.
So if it were at 6% interest, we're doing no down. Well,
Yep.
all right. So we're assuming. Well, we got to take the down
Yeah, just
payment off.
principal and interest, and just put the 20.
Well, we have to
$1,054
take.
at
So
3%.
when we're doing this, they're not paying.
Then at 6%, you at almost $1,500. So you're talking about a $450 difference per month from the 3% to
And
the
the 6%,
6%.
right?
Correct.
So you're investing the same amount, but so the buyer's coming in, but what was it? The 250 used as an example,
Yeah.
with 20% down. So let's say that seller balance was 200,000. Everything you're basing it on is based on what their original loan amount was. So let's say they originally paid 240 or whatever for it. I mean, you're gonna have a lower monthly payment by what, about $400
$450, yep.
or so. So if you're putting down approximately the same amount of money to get into the property, but you're going to have $400 a
Right.
month less to pay by assuming a mortgage instead, that makes
And so
sense.
that's kind of what I'm talking about. Let's say they owe 200,000, but the seller wants 250.
Right.
They were already planning on putting down the 20%, so they have the $50,000 in the cash to be able to work with.
Exactly.
Yeah. So, that's more so because you don't have to assume that it's gonna be like a loss of equity or, now this $200,000 house is worth 400,000. That could be very well be the case.
Why are
Right.
you assuming
But
the loss of
technically,
equity
the
though?
sellers,
I'm not
the
assuming that it's
payment
a loss of
that this
equity.
current seller would have would be based on their original loan amount, not their balance at the time.
Mhm.
Because they probably bought the house for 240 or whatever they bought it for, minus
Yeah.
their down payment. But still, the new buyer is still going to save. If you're talking a 3% versus 6%, they're still going to save a few $100s where it makes
Mhm.
sense. If
And then you do have people that are giving gifts of equity.
right,
So, in those situations, your parents, grandparents, aunts, uncles,
Mhm.
friends.
That's another scenario that you just said where, I mean, you still got. I think you got to be approved for it, but that's another scenario
yeah, you
that
got to
where it
get
would work.
approved for it. Yep,
Mhm.
and then that eliminates your down payment requirements in most cases. And the lender, it just depends on how the lender structure it. But I mean, if you're buying from a relative, that's like ideal.
That's
Mhm. Yeah,
win-win.
so it's
Yep.
like we have my son is living in my dad's house currently, and my dad isn't trying to sell the house for more than what he owes on the house. He
Right.
just wants my son to take over the mortgage
Right.
by way of assuming it.
Yep.
And they've already talked to the mortgage company and know that he can assume the mortgage, obviously with certain credit, finances, all the things that you
Right.
need to qualify to show your ability to pay.
Now, does your dad have a lower interest rate or
Yeah,
just
he's got like a 3% interest rate.
okay? Because I was gonna say, in some cases, and this is the reverse side of that, the some buyers with all the down payment assistance and stuff that's going on, they may come out better just getting their own mortgage,
Mhm.
right? It again, it's a case by case scenario, but it's just an option that most people don't know
No.
about and haven't been using over the past several years.
So, but I think that makes more sense, a lot more sense in the higher dollar points.
Yeah,
You know what I mean?
exactly. Because if you
Yeah.
can you run that same scenario, say on 600,000, and just simply do the difference at 600,000, the difference between 3% and the 6%.
$3,600 at 6%, and then you at $2,500. So you got about a
You got about
$1,100 difference.
$1,100 difference,
Mhm.
right? So,
That's
and the reason this is important now is because you have those buyers with those 3% interest rates.
mhm.
See,
Wait a
before
minute. You did what?
600,000 at 3% interest is 25.29, and 600,000 at 6% is 35.97.
Yeah, like $1,000 difference.
yeah,
$100.
so
Yeah,
$1,000
11.
difference. So this is important to know for buyers and sellers now because what makes the assumable mortgage attractive is the interest rate.
Mhm.
Without the interest
It
rate,
is not
it
worth
kind
it.
of don't
Yeah.
matter, right?
Mhm.
So we had a lot of people buying homes at 3%, some even less than that.
Mhm. So
So yeah, that's why I say people need to look into that option a little bit more.
yeah.
Mhm. Okay. So, we had simple and standard. We talked about who is
Simple.
good or formal, my bad. Why I
Right.
keep calling it standard?
Some people do call it standard.
Oh, okay.
I
They
just
call it a simple.
yeah, I came up and just knowing it as simple and formal. Formal meaning that you had to get approved. Simple was just, hey, here's the paperwork. Fill it out and file it.
Simple was. I don't even. You think
It's
they still do?
simple.
Yeah, I wonder if they still do simple.
Not many lenders
Yeah.
do simple.
Yeah.
Yep. They want to know that you actually
Mhm.
qualify.
Good for our buyers wanting a low rate. Buyers that were ready to put down maybe more than 20% or some significant amount of money. Um, Maybe buyers that were receiving a gift of equity. Um, and did we talk about the types of loans that you have to have in order for this to work?
Um,
So it has to be a FHA loan or a VA loan.
Some conventional
I didn't know
loans
that.
are assumable as well. It depends on the lender.
Okay.
Yeah, I
Yep.
didn't know. I didn't know that.
And then if it's an FHA, they probably have mortgage insurance,
Yep.
which might change that. I mean, but you still will have a significant savings because, like, on that,
It's huge because you're
yeah,
gonna have
Yeah.
mortgage insurance anyway if you buy it now. If you get FHA,
Yeah.
yeah,
if you put less than
yes.
20% down, yeah, you're gonna have mortgage
Well, it's
insurance
gonna
anyway.
always be on FHA.
Right.
VA, there's no mortgage insurance. So those are the types of loans that you can look for. And we talked about that too. The time, so if you get with someone who maybe has, 15 or 20 years left or 25 years less,
Yep.
you're not going into a 30-year mortgage for those people who want to, have something they can pay off faster.
That's gonna be more difficult to do though because if
They're
you're
gonna
there, you're
have
gonna have
more
so much
equity.
equity. Yeah,
Yep.
that's gonna
But
make that hard.
here's the thing though, you still got people with those lower interest rates that might be in a situation where they have to sell
Mm-hmm.
or almost getting ready to face foreclosure. Then you can come in and actually assume that mortgage.
Seller, hold
So
on. Can we talk about some creative ways to use it?
yeah, yep,
Some seller financing,
yep. You can do that. Is
right?
it's so many ways you can do it as long
Mhm.
as the lender approve it, right? But you still got all your other stuff, your lease options and all that. But
Mhm.
just sticking on topic of a simple assumption, you find somebody that, and we see it all the time, they get ready to lose their house, they're a couple months behind, and you say, hey, they don't have time to put it on the market and take the benefit of all the equity they have. Maybe they got 50,000 in equity and they just need to stop the bleeding and get out of the situation. You come in with 10,000 and assume their mortgage, right? Now, if you can do that from an investment standpoint, or typically you would want more equity than that if you're going to buy it to flip it.
Mhm.
But if this makes sense financially as a rental property and you can come in and assume that mortgage and get them 10 or 20,000, now you saved yourself a lot of capital up front versus going in and getting a brand new mortgage and everything else involved. And now you can just rent the property out. Unless the mortgage unless it was some type of requirement for home ownership.
Mhm.
So if they had a mortgage that they had to live there for 3 years or some type of grant or something, you're probably not going to be able to do it in that scenario.
All right. And what else? Oh, land contracts.
Yep. Those are assumable too.
Mm.
Yeah.
So, and on a land contract on both sides says, well, technically, even with the lender, that's why lenders sell notes,
Mhm.
right?
There
But
too.
on land contract, both sides can assign their interest to somebody else for a fee.
Mhm.
So if I sold a property on land contract, I can assign my interest to somebody for an amount. Let's say the balance owed is 100,000. Somebody can come in and pay me my 100,000, but they're going to make 100,000 plus the interest.
Mhm.
So they would benefit long term. On the buyer's side, the person that brought it, they can also assign their interest, but they would need my permission, right? Just like you
He
would
just
from
taught
a
y'all how to
mortgage
sell a
company.
mortgage.
He did. But listen, we had a situation like that where a wholesaler remember I can't remember his damn name. Had the house over there off of 8 Mile
Mhm. I know you're talking about
where he should have
his
done that.
uncle, his uncle's
Mhm.
house. Well, we
Yeah.
kind of
Mhm.
did it in a way too with not really though. Never mind.
But all right, let's talk about okay. So as for a listing agent now
Right.
that's
Oh yeah.
going to a listing appointment and their seller, they're trying to come up with some creative ways for the seller to
Market.
market their house.
Right.
So how would y'all go about that?
I would say, when did you buy your home? If they tell me the year, I'm gonna say, oh, how much is your interest rate? Because we can't assume everybody
Yeah.
got
Mhm.
those great rates. If they tell me 3%, I'm gonna say, hey, we're gonna list this property. Here's an option for you. We're gonna list it, the normal FHA conventional VA, but you can also list your home as an assumption. Check with your lender to see what their requirements are. And a lot of lenders have an assumption package. If it's assumable, I'm gonna say we're gonna list it as an option.
Yeah.
It's not gonna guarantee we're gonna get a buyer, but it opens the door. You
Like
probably
in
have
your remarks, you could put, "Hey, assumable 3% rate."
Yep.
People gonna jump at that.
They are.
Right.
I mean, even now, even though the rates are going down a little bit, we just seen that's significant savings.
Yeah.
You know what I mean?
Yep.
And we use
Especially
other
when you
rates
go
too,
up higher in price point.
2.85,
Yeah,
3%,
people was getting
4%.
ridiculous rates.
You know, anything that's lower by a few points.
So for those people out there who are in some financial trouble,
Right.
and you do got that low interest rate,
Call me, Johnita Stanton, Legacy Park Realty, 313-478-5938.
Beep, beep, beep.
That's how our guests be. They be like, just hit my cell phone.
Right.
What's another creative way that we can tell people that I mean, there's other creative ways. There's so many ways. I don't know what to say because Reggie likes to talk about it.
I mean, you know, you don't want to say anything that's it's loopholes and things.
It's a lot of them. It's a lot of creative.
Yeah, if you're gonna get real creative, talk to your attorney. I don't want to get
that's legal though.
People
take damn attorney.
No, people take
legal loopholes. If it's a loophole, it's probably legal.
It is.
People take advice from online or social, and they don't get the full story, and they don't get all the we can only explain so much on the show, right?
Yeah.
But even if we explained it all, most people only gonna take in a portion of it, and then they gonna go act on it, and then they gonna be like, "That didn't work."
Right?
It didn't work because you didn't structure
your mama didn't
right.
have an assumable mortgage.
Oh,
that's
we didn't. Or maybe we had too much. So what about a scenario? You want to give a scenario
for an assumable mortgage?
Yeah, one that's a little creative, but that's not. It's
creative.
Safe. It's safe though.
Well, we have one right now where we have a client and they have a really nice, unique property, and they want a certain dollar amount, and we don't know right now if because it wasn't a traditional listing, so I didn't ask the question up front.
Right.
But now that we're kind of like thinking about it, it's like, oh, you know, do you know if your mortgage company offers a assumable mortgage?
Right.
Okay, well, you should find out. And then if you find out, maybe now that's something that can be put into the listing ticket. And let's say, for instance, you know, he has a high dollar amount home at 20%. That's like $200,000 that someone would, you know, be coming to the table with, right? I think. You doing the math? No, I asked a question. Never mind. But anyways.
What was the question?
I said at 20% down on that dollar amount, that's like $120,000. So you could find someone in that market, 600,000.
Oh, yeah.
You could find someone in that market that was already prepared to put down 20%.
Right.
Or maybe the seller is kind of like, well, if you can take over this mortgage payment and this rate, I can work out financing with you to repay the rest of my equity.
Right. You can do a second mortgage.
Yeah.
Nothing wrong with that as long as the lender know about it and it's recorded.
Hold on. Lender don't need to know. That ain't lender business.
A lot of people, some lenders want to know.
That's after
depending on the mortgage note that you got in place now.
But I'm saying
we are not giving legal advice.
Yeah, but
we are not attorneys.
Here's the thing.
No, we are not.
And we do not own
my recommendation is if you're selling or you're giving a mortgage to somebody, record it. Because if it's not recorded, well, here in Michigan, because you know it's the first to record. So like. If something happens with that property and they serve notice to all parties that have an interest on the property and none of your paperwork is recorded, you're not going to get those notices. So if they start the default on a first mortgage, you at least want to know that up front so you can get served as well. So you would know, hey, I need to go in and pay off this mortgage or prevent it from going to foreclosure because you lose out your interest.
You talking about as the second?
Yeah.
Yeah, if you're the second lien, holder, let's say let's say you came to me to buy the property, you assume my mortgage, but you didn't have all the money to pay the difference for what I wanted. And I gave you a second mortgage. I'm going to want to record that second mortgage to protect my interest, right? Because if you're behind on taxes, your insurance, I want to be notified the minute you start getting default notices. Now, if you're the buyer, I mean, but even as the buyer, I probably would want it recorded because I don't want nothing else to come up and
I
you
don't want
be
it
like,
recorded as the buyer, but I hear you.
yeah. I mean, everybody's different. I'm just telling people, talk to your attorney.
I mean, as a
I
seller,
believe in
for sure.
recording everything.
Or as one of the lenders, I 100% want
Yeah.
I want to record it. But as the buyer, if I don't got it, I prefer not to. But no, I thought you were saying that the first needed to know that there was seller financing. And I'm saying not necessarily.
It depends on the
what their
lender and how
paperwork say.
they're
They may have a
paper.
clause in there that
They may have
says
a
this mortgage
clause,
will become due if we find out that you have a second mortgage.
Hold on.
They may they might not put a due on sale, but they may say they may ask how much is the down payment. They especially if they're qualifying the buyer, right?
But you're not doing an 80-20 loan. So basically what you're doing as a seller financing, you got a first mortgage.
Right.
When you come back and do a second mortgage, you don't go let the first mortgage know. I'm talking about after the fact. After you purchase a house, you don't come and let the first mortgage know, hey, first mortgage, I'm about to go pull an equity loan on my house. So why would you need to let them know that you're getting a second from seller financing?
But what I'm saying is if somebody's assuming your mortgage and they send you that package, if they ask questions about how the buyer is coming up with the down payment and they check and you say, oh, I'm financing the down payment or whatever, that's why we talked about gift for equity, right? In all of those scenarios, the lender may want to know that. I'm just telling the general public, I know what you're talking about, but I'm telling the general public, every scenario is not going to be the exact same.
The due on sales clause. A due on sales clause is a mortgage contract provision that requires the borrower to repay the lender in full upon the sale or conveyance of a partial or full interest in the property that secures the mortgage. Mortgages with due on sales clauses are not assumable by the property's new buyer. So, I think that they could have a contract. Like if they find out that you have conveyed any of this interest to someone else.
They cannot.
Oh, okay.
I mean, if you're doing it in that
agree
transaction.
With Shaka. If they agree to allow you to transfer title, then that eliminates
we're talking they can't allow it if they don't know about it. So that's why I brought up the due on sales clause.
Right.
Due on sale clause
they can't allow it if they don't know about it
anywhere because
it's coming after the fact. It don't. Yeah, I know what Shaka's saying. I'm just telling on an elementary level. Just make sure every scenario is not going to be the same. So the scenario Shaka is given may or may not apply to what you're trying to do for your particular lender, for the type of loan, for the seller, for the state that you're in, because all states are different as well.
That's why we say creative financing. It's
creative, and if you get too creative, just get an attorney or some professional to advise you on the proper way to do it for your scenario. That's all I'm saying.
Yes, I agree with that.
Because people take stuff and run with it, and they be like, to give you prime example, you ever hear people advertise like buy tax lien properties? That doesn't work in Michigan, right? Because our state, we don't operate the same. But you know how many people in Michigan brought those courses? And they're like, oh, I'm looking for tax lien properties. I'm like, it don't work like that here.
Right.
You know what I'm saying? But they didn't pay $500 or $1,000 for a course that's useless here, so they got to try it in another state. So that's what I'm saying. Like, just get some advice in your area for your particular deal, for the type of deal that you're trying to do with that type of lender and that type of loan.
I want to give one last scenario, then we can stop. One that I feel like will work for people in the higher dollar range. So let's say that the person does have, say you purchasing a property for $750,000, and then they got a $400,000 or a $500,000 mortgage. You got to bring the $250,000.
Right.
You got the $250,000, but you didn't really want to have it in the house per se.
Right.
I would still go get that. What I said, $500,000. $500,000 3%, because at 6% is $3,000. At 3% I'm paying 21. So I'm saving about $900 a month there. And then if I need my money to do whatever I need to do, then I'm gonna go back and get an equity loan or equity line of credit.
Your money would just be there sitting in the house and not in the bank whenever you need it.
Well, you may need it though. So that's what I'm saying. So people might be like, oh, well, I need my money. All right, you can go right back and get your money.
Right.
Because you have that equity in the house.
But you're going back to get it at a different rate too.
For sure. But you still got the $500,000 at the 3%.
Yeah.
You know what I'm saying? So
you're not,
still saving.
In other words, your loan is not at the current rate. Part of it's at 3%, part of it is at the current rate.
For sure. You go do your refinance, you go get your equity line or equity loan at the new rate.
Right.
But that's only $250,000.
Right. So in other words, you might be paying 6% on $250,000 and 3% on $500,000 instead of paying 6% on $750,000.
Correct.
So everybody go do the numbers, run your numbers and see what makes sense. And this is how you think it through long term to see what's going to benefit you the best.
Yeah, that's it.
All I got. I mean, we could talk some more. We can come up with a bunch of scenarios.
I think we could. How long has it been? We ain't getting no timer yet.
So if y'all have any questions about assumable mortgages, just reach out to us, comment in the comment section, and we'll explain it in further detail. But just reach out to us. And your scenario may be different, or it may be unique, or it may benefit you, or it may be the worst deal you can do. But we need, you just need to talk to a professional that understands it.
The worst deal you could do? Is that possible?
Oh, yeah. Yeah, it's a lot
I
of.
almost had the worst deal I could do. My first deal doing the deal.
Yep.
That's a wrap.
All right.
Almost went bankrupt.
Well.